Welcome to Accounting Actuals. We simplify accounting and bring practical insights on the financial tools that every business needs. If you truly understand accounting, you understand definitions. Certain definitions are the language used at the highest levels of finance and accounting, and understanding them lets you follow how real business decisions are framed. Today, I'll take 5 important accounting definitions and break them down into simple parts so they make sense. Let's dive in. Asset is resource controlled. An asset is a resource controlled by the entity as a result of past events from which future economic benefits are expected to flow. Let's break it down. Notice the word controlled, not owned. An asset is not simply something you own. Control is more important than legal ownership. Past event means you can't record future hopes. You can't record things you're only planning or hoping for. Future economic benefits can be cash, services, or cost savings. That's why leased assets, receivables, and even some rights qualify as assets. This is why accounts receivable are assets, even though cash hasn't been received yet. And this is why leased assets, like leased vehicles, can appear on the balance sheet because the company controls their use. Liability is present obligation. A liability is a present obligation of the entity arising from past events, whose settlement will result in an outflow of economic resources. Key clarifications. The obligation must already exist. The entity must have little or no discretion to avoid settlement. Payment doesn't have to be in cash. It can be goods, services, or equity. That's why provisions, loans, and payables are liabilities, but future intentions, budgets, or planned expenses are not liabilities. In simple words, if the company can't realistically avoid payment, it's a liability. Equity is residual interest. Equity is the residual interest in the assets of an entity after deducting liabilities. In simple terms, creditors get paid first. Whatever is left belongs to the owners. Key clarifications. Equity is not a claim with priority. It is what remains after creditors are satisfied. That's why equity is sometimes called the residual interest. If the company were liquidated today, equity holders would receive whatever remains after all obligations are settled, which could be a lot or nothing at all. Revenue is an increase in equity. Revenue represents increases in equity arising from ordinary business activities, excluding contributions from owners. Revenue is recognized when control of goods or services is transferred, not when cash moves. Key clarifications. Revenue is about earnings and its impact on equity. Revenue is about performance, not cash. It must arise from ordinary activities. Owner investments are not revenue. This is why receiving cash from a customer isn't automatically revenue. Accounting separates money from meaning. Cash tells you when money moved. Revenue tells you when value was delivered. And lastly, expense. Expense is a decrease in equity. An expense represents decreases in equity arising from ordinary business activities, excluding distributions to owners. An expense is recognized when economic benefits are consumed or obligations are incurred, not when cash is paid. Key clarifications. Expense is about cost consumption and its impact on equity. Expense is about performance, not cash. It must arise from ordinary business activities. Owner distributions are not expenses. This is why paying cash isn't automatically an expense. Accounting separates money from meaning. Cash tells you when money moved. Expense tells you when economic value was used or consumed. Was this helpful? Don't forget to subscribe for more business finance tips that actually make sense. Thank you so much for watching. For more information on how we can support your financial goals, be sure to check the details in the description below or visit our page.